All right, well, welcome everybody. Thank you for joining us today. My name is Andrew Doffney, and I'm the Instruction and Outreach Librarian at the New Jersey State Library. And it is my pleasure to present James Goodman, who is a home finance consultant for the Credit Union of New Jersey. So welcome, James. Thank you for agreeing to speak today.
Absolutely.
bef-
Thank you.
Yep. Before we jump into the presentation, just a couple of housekeeping items to go over. We will be taking questions today, and we'll be answering them at the end of the program, but please feel free to submit them at any time using the questions box in your GoToWebinar dashboard, or you can email me directly. My email address is on the screen there. There is a survey that'll be available at the end of the webinar as well as in a follow-up email. So if you could please take a minute, complete it. We really greatly appreciate your feedback, and it really does help us as we move forward with our programming. And on the screen here, the last bullet point you'll see is a link. The Credit Union of New Jersey offers fantastic financial resources and other things regarding financial education. So I would really encourage you to take a look at it. You don't need to be a credit union member to take advantage of the resources that they have there. And I will make sure to post the link in chat so that everybody can access that. One last thing before we dive into the program is just a quick overview of the GoToWebinar dashboard for those of you who might be new. This is what your dashboard should look like. If you do not see this, look for this orange box with a white arrow either at the top left or right hand side of your screen. That will open and close the dashboard, and it's possible the dashboard loaded closed on you. Additionally, if you can hear me but can't see James or can't see the screen that I'm sharing, look for a blue clover type icon at the bottom of your taskbar on your computer or laptop. Sometimes maybe if you're working in another program, you might have minimized this. If you click on that icon, that should bring up the screen and you should be good to go. At any point today, if you're having any issues or can't hear anything, you can use this raise hand button here to alert me that you were trying to get in contact, and then hopefully we'll be able to resolve that issue for you. And lastly, as I mentioned, we will be taking questions, and here's this questions box. You can just type in your question there, hit send, that'll get sent to us, and we'd be happy to answer that question at the end of the program today. So that is everything that I have for you. So it is my pleasure to transfer it over to James.
All right. Thank you again, Andrew, and thank you everyone for joining us today for our webinar. Um, I will be going over with you like home buying basics. We would walk through the process of buying a home. We'll walk through the how we qualify you to purchase your home. So we'll try to take you from A to Z on what you will run into when you're looking to make that purchase. And uh, and then like Andrew said, we will actually answer any questions that you may have at the end of the webinar. So we'll just dive right into it so we can get moving here. Once again, my name is James Goodman. I am a licensed mortgage loan officer. This is my license number 222958. I work for the Credit Union of New Jersey, and this is my contact information. We'll have this information again if you need to reach me at the end of the webinar. So, one thing I always like to ask when we have these webinars and we have seminars is, why should I buy a home? Well, a lot of times what I end up telling people is it's just a big sense of rewards, big sense of belonging to a community. It brings a security to you and your family. You no longer have to pay a landlord rent because you now own the property, which means you are now the landlord. A lot of times people personal goals is to become a homeowner. So it helps with personal satisfaction to reach some of the goals that you may be looking to obtain. Tax savings, when you get ready to file your taxes, it's an unbelievable difference in what you will receive back as far as taxes in your tax returns versus what you do what you receive when you're just renting. It's an investment. This is probably purchasing a home is probably one of the biggest investments you will make, because what it is it's not just buying the home and saying, okay, I'm a homeowner, I'm gonna make a mortgage payment. At some point that mortgage payment, God willing, that mortgage will be paid off, which means that everything that you've paid off into the house is called equity. That all of that equity is actually money for you and your family. If you decide you wanted to rent that house out, the house is paid off, you're just collecting rent at that point. If you decide you want to sell it, if the house is paid off, all of the equity, whatever that house is worth, that comes back to you. So it is a huge investment in your future. I know people who purchase their first homes. I've actually been in the business long enough that I've helped people purchase their first home. That first home has become an investment property, and they went on and purchased a second home as a primary residence. So it is a huge investment, an investment for you and your family in your future. Stability for you and your family also. Like I said, it's no longer paying the landlord. Don't have to worry about the landlord taking a rent payment up on you. You have a mortgage payment depending on what the program you set. You will set up the mortgage payment to have the payment the same every month, and it's just a sense of that stability along with the sense of ownership and being living in a community that you are a homeowner and you have an investment stake in that community. Let's see. Now, we have what I call the key players when you're looking to purchase a home. So we'll start with what is called the buyer, which would be probably you as a first-time home buyer, and then you have the seller. So that's the person who's selling a home. That's the person who has that yard sign up in the front yard saying for sale. That's the seller. Then you have what is called real estate agents. Now, real estate agents, you have usually two in a transaction. Sometimes you can have one. Now, so when you're looking to buy a home and you drive past that house that you really like the for sale sign is in the front yard, you pull in and you go in and look at that house, and the realtor is 9 times out of 10 is going to ask you, hey, do you have someone that you're working with? If you don't have a realtor that you're working with, that realtor who's listing that house can become your realtor also. That would be called a dual agent. I usually recommend that if you can to have a agent, what is called a buyer's agent, which would be your agent. That agent is responsible for going around looking for the type of home that you want and looking out for your best interest. Not that the dual agent would not do that. It's just that that person is working for the seller and working for you, and you want someone to just focus on you. So those are the difference between the buyer agent and the seller agents. Now, just remember one thing as a first-time home buyer, if we have first-time home buyers on the call, is that you do not pay a real estate agent any money to take you out to find a home. So, and most real estate agents will not ask you for any money. If they do, then I would suggest you find another agent. So the way a real estate agent gets paid is that seller agent. Let's say they're selling the house for 200,000. The seller and the agent has probably already agreed to a price of probably 190. That $10,000 that's added onto that price will help pay the salary for the seller's agent and for the buyer's agent. So your agent, the buyer's agent, is responsible to help you find that house in order for them to get paid. They work on 100% commission. So you want to find an agent, you want to find someone you're comfortable with, and then you want to stick with that agent in order to find the house that you really want to buy. Next you have in the transaction is you have a lender, which could be us at CUNJ, or you can talk to other banks as well. But what we have with the lending process, you have what is called the loan officer, which is what I am, and then I have a processor, and that processor helps me help you get your loan approved. So whether they do all of the documentation that they need to gather, W-2s, pay stubs, bank statements, any information they need to help you get that loan approved, they will call you, they will introduce themselves to you, and they will say, this is the stuff I need, and they will actually track you down to get that information because they know what they need to do in order to get that loan approved for you. We're both looking to package that deal and get it into an underwriter's hands, and we'll talk more about that in a few minutes. You have also your attorney, and certain parts of New Jersey, you don't need an attorney. Certain parts of the state, you don't need an attorney. Some parts of Pennsylvania as well. So you can use what is called a settlement agent. And both people who work for you, whether it's a settlement agent or an attorney, will have to use a title agency. So what does a title agency do? Is they order title work on the property that you're looking to buy. The process using an attorney can be a little bit more expensive because you have to pay an attorney's fee, but the attorney is then responsible for doing a lot of the legal work that you need done on a property. A settlement agent can do the same, but sometimes as a first-time home buyer, I would usually suggest having an attorney just because there's so much documentation that's going to come in front of you. It's going to have a lot of legal language in it, which an attorney can read through for you. Home inspector. This is big for a purchase, especially if you're a first-time home buyer purchasing. A home inspector will go through that house. The house that you saw and you loved, or you was looking for a 3-bedroom, 4-bedroom, 2.5 bath, 3 bath. That house you love, oh, this house has everything I need. So you love it just by looking at it. The home inspector is going to go in that house and look for any type of potential problems in that house that you love so much. Whether he's going to check and he or she will check to see if there's a roof problem, if there's plumbing problems, heating problems, a drainage problem, anything that can go wrong in that house that's going to be that can go wrong. Well, as soon as you purchase or close on it, is what that home inspector will be looking for. I always suggest as a first-time home buyer is to go throughout. You will go throughout the house with the home inspector. The reason is because if this is the first time you're owning a house, there's a lot of things about a home that's a little bit different that you want to know where everything is located. For example, if you have to turn off the main water in the house, the home inspector will show you where the main water system shut-off valve is at, the heating system, the electrical system, the things that run that house. They're going to walk you through all of that type of information. Home inspections. Price can be a little bit pricey, and this is one of the things you would do towards the beginning of once you find a home that you want to buy. Price range can be anywhere from $500 to $700, but like I said before, I definitely recommend it because, and the reason I do because I have seen deals that actually will fall apart because if you do a home inspection and it turns out that there's a lot of potential problems in there, you can actually cancel a deal at that time. Unfortunately, you would have already paid for the home inspection, but you still it saves you money in the long term rather than buying a house that you're going to originally have to dump $20,000 into that you didn't do a home inspection on. The home appraiser, that's who the bank will send out. And what we're looking to do with the home appraiser is find out the true value of that property. So that person selling the house for 200,000, 300,000, we're going to send an appraiser out there to make sure the value is the 200,000 or 300,000. If the value comes in lower, we will then address that with you, your attorney, or your settlement agent, and see if we can get the seller to reduce the price to what the value is. If the value comes in higher, that's called having equity in the property, and we don't do anything but close. You close on a property that has equity in it. We put on here homeowners association. This is just in case you're looking to buy a condo or townhouse or planned unit development, which is a PUD. Those that the homeowners association dues is a fee that you will pay into the mortgage payment. It's a monthly fee, but it handles all of the upkeep around the property. Also handles coverage insurance of the property, which we'll talk about insurance, and we'll go over what I mean by coverage insurance. Because of the complex, it's a little bit different than owning a house. You actually cover the whole complex. So the fee, depending on what amenities you have with that condo or townhouse, for example, if there's a swimming pool, health club, that type of thing, your association fee can be a little bit higher because there's more things to actually maintain in the property. But that's what the homeowners association fees are. So those are some of the key um, elements and key players that's involved in purchasing a home. Now let's get into what actually happens and how do we actually get you qualified to purchase that home. And so getting pre-qualified. So what does getting pre-qualified means? So remember I told you most real estate agents work on commission. So there's several things they want to see from you before they actually take you out to look at a property. One is, can you actually purchase a home? So they will like to see a letter from a lender saying, yes, we've spoken to this person, we've taken their information, we've qualified them for this amount of money. This also helps you because if you're just driving around looking at properties and you were never qualified, you may look at a home that might be a little bit out of your price range. You love it, but then when we actually run the numbers and stuff, you don't actually qualify for that property, meaning that the payment is too high for the type of income that you're bringing in. So this actually helps you set up where you want to be when you go out there shopping. I know a lot of people who qualify pretty high, but then they say, I want my mortgage payment to be a certain amount. This helps us set up that mortgage payment, then set up that letter. So when you give it to that real estate agent, we're kind of keeping your payment where you want to be as far as being comfortable in that property. So what happens is it takes you through the entire mortgage application process verbally. So what we're basically going to do is ask you information like how long have you been on your job? We're looking for 2 years of employment. Um, uh, who do you bank with? We're looking for how much do you have in the bank? How much do you plan to put down? We do have to run a full copy of your credit report. So when that means that it's going to be it's not going to be a soft pull. It's going to be a full pull of the reports. So it can actually pull your score down a few points, not a lot. And chances are when you get qualified, you can actually qualify with different banks. So if you do it all in a certain time window, your credit score will stay the same. but it actually will. And the reason we need three, we have to pull three repositories: TransUnion, Equifax, and Experian, because we want to make sure everything is the same on all three, and making sure there's no surprise payments that we missed in the qualifying stage. It's so this is the portion that helps us get you ready to get that letter that you need from a real estate agent. Now, getting pre-qualified is a little bit different than getting pre-approved. The pre-approval part is a little bit more solid than pre-qualified. Most times you only need the pre-qualification letter in order to go out and look for a property. But some real estate agents may ask you, hey, can you get pre-approved? And what is the difference? Basically, like I said, pre-qualified is verbally all information we need to get from you. So you told us you've been on your job at the state of New Jersey for 2 years. You told us you have this amount of money in the bank. And so all of the verbal things that you've told us to get pre-approved, you need to back it up. So we're going to ask you for your W-2s for 2 years. We're going to ask you for pay stubs, your most recent pay stubs for 1 month. We're going to ask you for your tax returns. We're going to ask you for your bank statements to show the money that you have to put down. You're going to produce that information to us, and then we're going to take that loan and that information along with your application and submit it to an underwriter to actually underwrite the file without a property. And so once the underwriter underwrites the file without the property, then we'll issue you what is called a pre-approval letter. That's a faster way to go also to close on your house, because the underwriter has already underwritten your loan. All we need to do at that point is, once you find a house, go into contract, is we order the appraisal, and we can actually close the loan a lot faster. So the difference between the two is getting pre-qualified is just basically us taking verbal information from you. Getting pre-approved is us actually taking documentation from you and actually getting you ready to go. Either way, we will get you the letter that you need to actually go out and start shopping. So what happens when we get you qualified or get you pre-approved? We're going to take a little scenario here and show you exactly what we're looking for and the numbers, that the guidelines that we have to follow through getting a person qualified for a mortgage. Now, just so you know, it's not on this chart, but every mortgage company has to or look to sell their loans to an investor or close under investor guidelines. So the investors, and you may have heard of these investors or maybe seen a commercial on them, but they are called Fannie Mae and Freddie Mac. Those are called conventional investors. And then you have FHA, and then you have VA. Now, the difference between the two is the conventional investors, Fannie Mae and Freddie Mac is very conservative as far as if you had lates in the past and that kind of thing, sometimes it can make it pretty tough to get a mortgage as a first-time home buyer. Any type of negative information sometimes can stop us from getting you approved with those two investors. So a lot of times first-time home buyers will actually look at a FHA product. Currently at the credit union right now, we do not have FHA, but we are still in the process of trying to get FHA. And what FHA does is it lets you put down a low down payment, but it also is not as tough on credit. You still have to have they would like you to have a 620 credit score. You can do a little bit lower, but you may have to put a little bit more money down. But they're looking to help that first time home buyer get into a house. Fannie and Freddie also have a low down payment program, but like I said, sometimes their guidelines are a little tough on credit and credit scores, where a lot of people end up going first FHA in order to get into that property. The last one is that VA that I mentioned. VA is strictly for military veterans and people that serve in the military or have served in the military. So you have to have information showing that you are a veteran in order to go for a VA mortgage. Out of all four products, out of all four investors, I think the VA mortgage is the best one, because when we currently don't have that at the credit union as well. But the reason I say it's the best one, it's we're doing some type of thank you back to the people that have served and protected us. And biggest thing is no money down product. You don't have to have mortgage insurance, which I'll go into in a few minutes. And the interest rate is very competitive, so it's a really good program. But that's just in case you are a veteran. So that's what the VA program is. Now, with all of those products, all of those investors that we use, we have to qualify. And when I say we, every lender has to qualify under those guidelines, depending on which product they're going to take you to or which investor they're going to take you to. So for example, we're going to look at mostly conventional, because that's what we do at the credit union. Now, when we're looking to qualify you, the first thing we want to know is, okay, what is going to be your principal, interest, taxes, and insurance? We call it PITI. So it's all about the PITI. So what is PITI? And we're going to break it down for you. So if you looked at a property, let's say we're looking to get you qualified for $200,000, and we're going to have you put 5% down. So 200,000, your down payment is going to be $10,000, and the credit union is going to give you a loan for the rest, which is 190,000. So your loan amount will be 190,000. Estimated interest rate, rates are a lot lower than this now. We did this chart a while ago, but let's say the estimated rate is 4%. Property taxes on this property. Now, what are the property taxes? Property taxes, wherever you look to buy, this is big for first-time home buyers because this can determine what your mortgage payment, how high your mortgage payment is going to actually go. So one of the things when you are going out with a real estate agent and you do have that letter in your hand and you see a house that you really like, one of my top questions would be to that real estate agent. First one is probably what's the sales price, and second one, what's the property taxes? Because taxes, depending on how high they are for the year, is what's going to go into your mortgage payment. I know people who purchase homes, and their property taxes for the year was $12,000. That's $1,000 a month that's going to your mortgage payment. We divide it by 12. Homeowners insurance. Now, this is something you will go out and get. A lot of times uh, we're we would have people go to New Jersey manufacturers because it's state insurance, and it's very good, very competitive prices. And so they will actually get the policy. Whatever policy you bring to whichever lender you decide to go with, that's the payment that's going to go into your mortgage payment. So how do we break it down? So the first thing we're looking at is what is your actual mortgage payment. So remember, we're loaning you $190,000, 4% interest rate. Your mortgage payment, your actual mortgage payment to the credit union every month is $907.09 according to this chart. So it is a factor a program that we use that gives us that payment. $907.09. That's your actual mortgage payment. Everything else is the stuff that's added on top of it. Now, your taxes in this scenario, our taxes are $5,000 for the year. We divide that by 12, it gives us $416.67. That's your monthly payment for taxes that's going to go into your mortgage payment. Go with your mortgage payment. Homeowners insurance, $700 a year. We divide that by 12, $58.33 a month. That's going to be added as well. Now, the next things we add on is depending on what you put down. Now, conventional mortgage programs, if you put down 20% or less, you do not have to worry about this thing called PMI, which is called private mortgage insurance. If you put down 15%, 10%, 5%, and 3%, you will have what is called PMI on it, which is called the insurance is to protect the lender just in case of foreclosure or default. And the reason it's usually a little bit higher depending on how much you put down. For example, you put down 3%, sometimes it could be a little bit higher because the risk is higher of you maybe walking away from a house that you've only put 3% down on versus if you put down 20%. So that's why they have the insurance on there. Now, with all conventional programs, the insurance does go away after you reach a certain point. For example, if you reach 80% loan to value, you can request an appraisal on the property and can have PMI taken off of that property off that loan at that time. If you do not do anything when it reaches 80% loan to value, once it reaches 78% loan to value, meaning that you've paid down the house to where you only owe 70%, 78% on the mortgage, then the PMI will come off automatically. So that's what PMI does. It's just insurance that covers the lender in case of foreclosure default. Now, so when you put all of our numbers together, our principal and interest, 90709, our taxes 41667, homeowners insurance 5833, and PMI $120. That gives us a mortgage payment for the $190,000 loan for $1,502.09. So that would be the mortgage payment that you would have to start you off at getting you qualified. Now there's one more step that we have to do in order to see, do you qualify and can we get you a letter to go out and purchase this home? So the next thing we would do at that point is then we start focusing on you and your income. So in this scenario, your income is $50,000 a year. We divide that by 12, gives us $4,166 a month and 67 cents before taxes are taken out. So you're not bringing that home every month. We realize that. So with us running your credit, we now see you have monthly debt of $400 a month. You only have a car payment or you only have student loans. So that's your monthly debt. So how do we qualify you? So in the mortgage guidelines and Fannie Mae and Freddie Mac guidelines and FHA guidelines, they say ratios need to be 29-45. So what are ratios? So 29% of your income we do not want to be taken up by your mortgage payment, and 45% of your income we don't want to be taken up by the mortgage payment and your debt. So the way we figure that out is we take that principal and interest payment of principal and interest taxes payment of $1,502.09, and we divide that into your income of 4,166.67. So 36. So our front ratio is over the required front ratio from the investor. But we're still okay with that because the main focus for us is the back ratio to make sure that you're not at a 50 or 55 on that back, because then you do not qualify at that point. So the reason we focus on the back is because that's really carrying your mortgage payment plus the debt. And that's going to really tell us if you can afford to be in this property or not. So that's how we get the next ratios. We go the mortgage payment of 1,502.09. Your monthly debt, remember your car payment or your student loans, $400 a month. Put those two together, that's $1,902.09. We divide that into the 4,166.67. That's taking up 46% of your income before taxes are taken out. We're a little bit over that, the guidelines, the back ratio for our guidelines, but we can still have that loan approved because it's right on the bubble of 45. So we can still get that loan approved. So you would still be able to qualify. So the loan will qualify at a 3646. The reason we don't want to go too much higher than that, because remember, we're looking at $4,100. Your payment is $1,900, so already about almost, you rounded up a little bit, almost 2,000, and taxes haven't been taken out of your income yet. You still need to live. You still need to buy groceries, utilities, all of that stuff. So we do not want to go too much higher than that, because just to make sure that it's going to be affordable for you. So that's why we have to go by those guidelines. FHA and VA use the same formula as far as qualifying you for your mortgage. So in this case, we are able to get you qualified, and we are able to get you what is called a pre-qualification letter and a pre-approved letter. And so now you're able to get ready to go out and start looking at a property with the real estate agent. Next thing we will go over you in that same process, though, is closing costs. And what is closing costs is, so remember, we're putting down $10,000. That's your down payment. You have a second portion of that. That's a big chunk of money that you need to pay too, which is closing costs. And closing costs can range anywhere from $4,500 to $6,000. And I'll go through it with you where those numbers come from. Now, lender fees. Every lender that you talk to will have lender fees. Credit union only charges their members what is called third-party fees. And basically what that is if we have an appraiser to come out and do an appraisal, that appraiser is the third party. They will send us a bill, and that's the fee that we charge you, is whatever the appraiser is charging us to do that appraisal. IRS, we have to do IRS verification. We have to do employment verification. We have companies that will do those verifications for us. They send us a bill. That's the bill we charge you. So when you put all of the credit union numbers together, it could be about $800 and $872 or somewhere in that range. But there's no points, there's no junk fees involved. Now, some lenders you may talk to, you may run into junk fees. You could sometimes run into points. What are junk fees? Usually, if they charge you an application fee, usually they charge an underwriting fee, a doc prep fee, FedEx fee. Those are all called junk fees, and sometimes some lenders charge them, some lenders don't. Credit union doesn't charge you any of those. The inspections we do not normally put in your closing costs, so it won't be in that 45 to 600, but I always put it down just so you can be aware. Inspections, like I said in the beginning, can run you anywhere from like 600 to $500 to $700, depending on the things that you have done. But it's very important and very needed to do a home inspection, especially as a first-time home buyer. Prepaid interest. Now, what is prepaid interest? That's a fee that you can actually determine how high or how low you want it to go. So what happens is, a lot of times if you have friends who own properties, a lot of times when you ask them, oh, when did you close? Normally they will tell you that they close somewhere towards the end of the month. The reason they do that is because when a lender gets ready to cut that check, I think in our scenario with 190,000, if a lender cuts that check, $190,000 check, and they close it at the first of the month, and there's 30 days in that month, they're going to charge you interest on that 190,000 from the 1st to the 30th. That's called prepaid interest. That will be part of your closing fee. So that sometimes can be about another $400 or $500 that's included in your closing costs. So a lot of times when you talk to your friend, they say, hey, we close towards the end of the month. The reason they do that is because if you can close on the 27th, 28th, of the month, let's say you close on the 27th, they're only charging you 3 days of prepaid interest, which could be almost about $60 versus you paying $400 or $500. So that's why a lot of times people like to close towards the end of the month to avoid paying a lot of prepaid interest to the lender. Title work. This is probably one of the biggest fees that you will see on your estimate or on your closing, and your attorney will order your title work, or if you use a settlement agent will get the title work ordered. And title work can range anywhere from 1,600 to almost about 2,800, depending on what needs to be ordered. And what is title work? So let's say title work make sure that the property that you're buying is free and clear of any type of liens, anything that can come back and cost you money after you're already in the property. So for example, if you're buying a house that was built back in 1890 and it had maybe 10 different owners, the title work and title searches will go all the way back to the original owner to make sure that every owner transferred that property and made sure the transfers were free and clear. So that way, when you actually take ownership of that property, you do not owe anything on that property. So that's what title work will do, make sure. And it also makes sure you're free and clear of any judgments or any child support liens or anything like that. So the reason we do that is to make sure liens can actually come and take over your mortgage if someone decides to go to exercise that lien. So that's what the title work does, is make sure the liens are clear. Escrow. Now, escrow is, so when I gave you the principal, interest, taxes, and insurance, that taxes and insurance is called your escrow. And so basically what goes in escrow is your taxes every month and your insurance every month. So the way it works is this: let's say, for example, you're buying in New Jersey. New Jersey wants their payments of taxes every quarter. So January, February, March, April, May, and June. So the way it works is when you get ready to close, every lender will take about 4 months of your taxes and put it into an escrow account. The reason they do that is to make sure that when you close on a property, if the taxes is due to the township and if the seller hasn't paid the taxes, then you will need to pay them at the closing, because you're going to be in that house when the bill comes out. So the lender will take those 4 months of taxes and take 3 months and pay the township. If the seller has already paid the taxes, then the seller is probably going to want to be reimbursed, because the seller's not going to be in the property once you close on it. So then the attorney or title company will give a check to the seller for 3 months of taxes, and then the other month will stay into your escrow account. So every time you make that mortgage payment, that tax payment goes into what is called your escrow account to make sure taxes are always paid on time. If taxes are not paid on time on your property, your township will send you a late notice and send you a bill, and then send you an action notice really fast, because taxes is what runs your town. So the fire department, police department, if they're paid off the taxes, the school system has a large percentage of your taxes. Everything to run that town and to maintain your town or your city is based off of your property taxes. So that's why it's very important when the taxes are set up that we have it set up the right way to make sure that we're paying the right amount to your township. The next thing that goes into your escrow account is your homeowner's insurance. Now, like I said at the beginning, you will go out and get your insurance policy. So let's say you go to New Jersey manufacturers and they tell you, hey, your policy is going to be $700 in our scenario, and you write them a check for $700, and then you will send us the copy of the insurance and a copy of the bill. That's what we put into your payment. So you say, well, why am I putting in escrow if I had to write a check out to them? So the way it works is, let's say we're January, so let's say you're closing on your house in February. So you're going to give us a policy from February 2021 to February 2022. Every time you make that mortgage payment, we're going to take that portion out of your homeowner's insurance and put it into that escrow account. Then in February of 2022, the bill from New Jersey manufacturers is going to come to the credit union, not to you. You'll get a copy, but we'll get the actual bill. And we need to draw that money out of your escrow account to pay your insurance from there for the next year, from 2022 to 2023. So that's the way it works from there on out. So that is called your escrow account. So there are people that once you've owned a home for a while, you can, 4 or 5 years of being in the house, being an experienced homeowner, you can opt out of your escrow and say, hey, I would like to pay my own taxes and insurance. And as long as you've been on time with your payments and everything, you can actually do that on your own. It gets a little risky though, because if you don't, like I said, if you don't pay that township in time, they will come looking for you. The attorney fee is usually about anywhere $900 to $1,000. Some companies may have what is called like an attorney buy-in, where you have a company attorney, and I think those fees are usually like $300-400, and the attorney will do the same thing for you. But normally an attorney fee is anywhere from $900 to $1,000, and the attorney will make sure they do all of the legal work for you. They set up the closing for you. They do the actual closing transaction for you. They will actually order the title work from the title company for you. So they actually get all that. So some information we're looking for in your closing costs won't be in until your attorney submits your attorney's bill and your attorney's title work bill, and they don't usually get the title work bill until they order the title work, which is usually the last thing that is done in a transaction. Next thing is the survey. The attorney and the title company will get the survey order. The title company usually orders the survey. What the survey basically is it tells you where your property starts and stops at. So when you actually look at a picture of a survey, when you actually close on your home, you'll see your house, your property, and you'll see where your property lines start and stop at. So this will, if you don't have a fence up, this is actually the first thing they're going to ask you. If you have a company come out to put a fence up, is, hey, can I see your survey? This is how they can determine where they need to put your fence line up at. And this is actually, you can determine if your neighbor's fence is in your property, also with the survey. So that's what comes also. That's why title work is a little bit more expensive, because all of those things are added in there. Recording fees. Your attorney will actually handle this as well. So what are recording fees? So once you close on this, you're going to have a deed, you're going to have a mortgage, you're going to have a note, and this information is sent to your county clerk's office to show that you own the property at this address, at this lot and block, and the township's going to send a bill to your attorney saying they're going to charge a certain amount of money to record those documents for you. This is the same place we send it after you pay off your loan. We send information and proof over to them the loan has been satisfied and paid off. They stamp your deed and mortgage paid, and they send it back to you as a paid, so that property is now paid off. So when you put all those together, estimated closing fees can range anywhere $4,500 to about $6,000. The big portion is the reason I have the range there is because it all depends on what your property taxes are. If your taxes are not that big, only 4 months, the number won't be that high. Like I said before, if your taxes are $12,000 a year, if we have to put 4 months in escrow, that's $4,000 right there. So that's the way the closing costs actually work. Now, let's move on to the whole transaction. So now we've qualified you. We've given you the closing numbers. Now you want to say, okay, what product do I want to go into? Choosing a mortgage product is probably the biggest thing for you, because that's going to determine how comfortable you're going to be in that property. So whether you do a fixed rate, 30-year fix, 20-year fix, 15-year fix, 10-year fix. So those are exactly what those numbers say they are. So if you do a 30-year fix, the payment is spread out over 30 years. It's usually the most affordable way to get a mortgage, because it spreads the payment out and gets the payment nice and low for you. 20-year payment's still pretty comfortable, but you're paying it off in 10 years less, so it's going to be a little bit higher. 15-year, you're paying it off in 15 years less. And 10 years, of course, you're really looking to get rid of that mortgage payment. Now, each one changes as you go. So the rate on the 30-year could be right now, I think they're right about 3.5, 3.25 somewhere. A 20-year, the rate can be like 2.875, but your payment is going to be higher because you're paying it off less. 15-year, your rate can be about 2.5. Payment's going to be a lot higher because you're almost doubling what the 30-year payment is going to be. So that's how you determine which mortgage payment you go to. 9 times out of 10, usually first-time homebuyers will go for that 30-year just to spread the mortgage payment out and get comfortable with making a mortgage payment. Next products you also have to choose from is you can do an adjustable rate if you want. Some people might be afraid of adjustables, but I'll explain to you how they work. So you have the 3-1, 5-1, 7-1, and 10-1. That number in front is your fixed rate portion. So if you do a 3-1, the first 3 years, that rate is fixed. 5-1, the first 5 years, that rate is fixed. 7-1, 10-1, they all work the same way. They're all amortized over 30 years, meaning the payments are spread out over 30 years, even though the portions of the front is fixed. So I'll take the 5-year and show you how they work though. So for example, if you took a 5-year rate, right now a lot of people aren't taking ARMs because the mortgage rates are so low. But when the mortgage rates are higher, the ARM is probably a little bit more, a little bit of a product that some people look at because it gives you a lower interest rate. So for example, a 5-1 ARM right now is maybe 2.5 interest rate. So that payment was based off of that 2.5 for the first 5 years. At that 6th year, that payment can adjust. It can adjust up or it can adjust down depending on where the market is at. For example, if you had a 5-1 ARM now and this is your 6th year, you would adjust down because the rates are so low that the market will move your rate down on an adjustable. And so how do the caps go up and down? So you have a 2% cap, which is called your annual adjustment cap. And that's so if you're 2.5 interest rate, and if the rate has a 2% cap on it, the highest it can go that 6 year is 4.5. The lowest it can go is a half, because it can also drop down. Remember, so 2 up or 2 down. Majority of the time, it doesn't work like that. What will normally happen is if the rate is going to go up on a 2.5, it's probably going to go up maybe a half. So the 6 year, it may go from 2.5 to 3%, or it can go from 2.5 to 2%. So that's the way the adjustables normally work. Some people may take them depending on what they're looking to do. A lot of times I have people, if they have a plan in mind and they say, this is my first house, I don't plan on being in here, you know, 3 or 4 years. Then I would say I would give them numbers on the 30 year, but I would also give them numbers on a 5 or 7 1. Just so why take a 30-year program and pay interest rate on a 30-year program when you can take an adjustable program? If you know your goal is this is definitely not going to be the house for you, you're only in it for a temporary time, then I would probably take something like that. Sometimes people take adjustables too, depending on if they buy a house that's a little higher than what they normally would look at buying, and they have income that's beginning income, but they know their income's going up. For example, like a doctor or an attorney, they usually salaries start off a little lower because of student loans and that kind of thing, but they know their salary is going to go up. So sometimes they take an adjustable through that period that the salary is low, and then once their income actually kicks in, and then they can actually refinance out of the adjustable, and work it that way. So it all depends on your goal and how you're looking to set up. Jumbo, I'll just touch on this just in case we have some big spenders out there. So what a jumbo mortgage is the credit union, the highest they'll go on a conforming loan, meaning a Fannie Mae sellable loan, Freddie Mac sellable loan, is 480,000. Anything over that is considered a high balance loan, and that goes up to probably about 900,000. Anything up to 900 to $1 million home is considered a jumbo loan. We can do those loans at the credit union, special prices involved in it. Special down payment involved in it, but I just wanted to touch on there just in case we had any big spenders out there. The lottery is up right now, so if you guys hit the lottery, you need that big loan, we have it here for you. All right. So let's go into the whole transaction here. Choosing your mortgage, you choose your down payment. It's all based off of your goals and what you're looking to put down. Credit union, most first-time home buyers, we do have a program where we can allow you to put as little as 3% down. It does not give you a lot of equity. So remember, what equity is all dependent on what you put down. If you put 20% down, you have 80% loan to value, but you have 20% equity. And like I said, depending on where the appraisal comes in, you can have more equity in there. Credit history is one of the things we want to look at. I was telling you before, Fannie Mae, Freddie Mac, and VEVE, very stingy sometimes as far as their credit. So they look at past credit. And I always tell first-time home buyers this because we have people who, may have had a shaky past, and then over the last 4 or 5 months, they started paying everything on time. But an underwriter can look back at the last few years, and that can determine sometimes the type of program and if we can get that loan approved or not. So that's one of the things you want to do as far as credit history is try to maintain, if you can, maintain the credit as best as you can, because that's one of the things underwriters focus on. Financial goals, property goals. You know, is this an investment property for you? Is this your first home? How long are you going to be in there? What are you going to do with that property? You're going to make it a rental property? You're going to move out? So all of those things you want to put into place when you're choosing that mortgage that you're looking for. Loan terms, 30-year, 20-year. Hey, I want to pay this house off as fast as possible. I'm going to take a 15-year payment, 15-year loan, and that type of thing. Closing costs. And closing costs is pretty much built into, like I was telling you before. If you find a house with high taxes and stuff, that can actually weigh into your closing costs. So let's walk you through a whole transaction. I'm just going to touch on credit really fast. What we do is do a tri-merge credit, hard pull, Experian, Equifax, TransUnion. We pull up all three of those scores. We do a couple of pulls also. So once you apply for your mortgage, they will do a pull. They will also do another pull on your credit before you close on your mortgage. So the reason I tell you that is a lot of times, so don't make any big purchases, any big transactions after you start the mortgage process. Don't go buy a new car. Don't go get new credit cards. Don't open up uh, any type of credit at Raymore, Flanagan, anything like that, because anything you do, we've qualified you at $400 a month. If you go out there and open up new debt, that will actually change your qualification numbers, and it may actually knock you out of qualifying for a mortgage. But the reason they do pull another credit report on you is because they want to make sure the credit is the same as it was when you applied for your mortgage. But that's at the end when you get ready to close. So that's why you definitely don't want to do anything until you actually close on the property. All right, your down payment, like I said before, you can do 3% down, you can do 5% down, you can do 10% down, 20% down will avoid the PMI. We do have programs that will allow you to do gifts. What are gifts? So if you have that relative that has pretty good money, pretty good income, a nice little savings, and they want to help you buy that first house, they'll give you money towards your down payment and closing costs, and they will just still fill out what is called a gift letter saying you do not have to pay them back. That's called the gift grants, down payment assistance. So most towns, some counties will actually give you a grant as a first-time home buyer. We do help you source what towns have grants available. A lot of times Mercer County, Burlington County, Huntington County, they have grants anywhere from $5,000 to $7,000. Um, it is income driven, and if you make too much, they will not allow you to get approved for a grant, but we will source them out for you at the credit union, help you find a grant if they are available in where you're looking to buy at. And down payment assistance is a little bit different from grants. It's usually private companies that will give assistance to first-time home buyers to help them find their first home. And we find areas, a lot of times we find like Ocean County and Burlington and Bergen County, I'm sorry, where we have companies that will give you what is called down payment assistance. So that's what works with the down payment. Now, the mortgage process, how does it work? We're going to walk you through the whole thing, and it will end in the webinar. So, mortgage process. So the first thing you want to do is you're getting pre-qualified. You've gotten the pre-qualification letter. That's us putting the application in, so we get you the pre-qualification letter or the pre-approval letter. You then take that pre-approval letter and you give it to your real estate agent. Your real estate agent, let's say you approve for 200,000, your real estate agent will then go to the NMLS, the multiple listing services, and start looking for properties for 200,000 in that price range that you're looking for. So you want to put two lists together as a first-time home buyer. You want to put the list of the things that you definitely want to have in your house, whether you want a 3-bedroom, 2.5 bath, 3-bedroom, 2 bath, and things that you would like to have, but you can live without. 3-bedroom, 2.5 bath, you may be able to live without the half bath. 2-bedroom, 2.5 bath, swimming pool, you may be able to live without the swimming pool. So you want to put the things that you definitely want to have and the things that you would like to have, but you can live without it. And put that together for your list as well. So when you're talking to the real estate agent, you can tell them the things that you definitely want to have and the things if they found it, hey, that would be even better for the house that you're looking to buy. That real estate agent is just going to pull up a list of the homes in that price range that you want, a list of the homes in the categories that you want. And then you guys will go out and start shopping for homes. The real estate agent will either meet you or drive you around to find that homes that you're looking for. It does not happen that easily. So take your time. I always tell people it's not like buying a pair of shoes. You want to make sure it's the right house. You're paying a big mortgage payment every month on this thing. So make sure you're going to be comfortable with it and make sure you love it. But once you do find that house you like, you're going to the real estate agent and you will go in and then you will write up what is called a contract, an offer contract on the house. Now, that contract is going to be presented to the seller. This is the only time your real estate agent will ask you for money, and that money is probably usually about $1,000. And why do you give that $1,000? That's called a good faith deposit. That's not going to the real estate agent. That's going towards your down payment. So remember, our scenario was our down payment was $10,000. If you get the $1,000 up front as a good faith, then you only need $9,000 because you've already given $1,000 up front. So the real estate agent is going to attach that to when they offer the contract over to the seller. Say this person is really serious about buying this house. The seller is going to then it's going to give it to the seller's agent. The seller's agent then is going to present it to the seller. The seller is going to say, hey, I like this offer. The seller will sign the contract. You've already signed the contract. Now you have what is called a agreed upon contract that you would then submit over to your attorney, and your attorney and the seller's attorney will start doing what is called attorney review. During that attorney review period, they're going to go back and forth. Your attorney is going to make sure they're looking out for your legal best interest. The seller's attorney is going to make sure they're looking out for the seller's legal best interest, and they're going to go back and forth and go through the process. You at that time, your real estate agent is probably going to tell you that you might want to do a home inspection right after towards the end of that time. The reason is you want to have that home inspection completed in case there's something that's going to pop up that one in that home inspection you want the sellers to fix before you close or give you credit before you close. You can present that to your attorney. You can present that to the seller's attorney. And two, if you decide, hey, this is a lot of things that need to be fixed, I'm gonna walk away from this process, then you can do that at that time and then get your $1,000 back and start back looking again with your real estate agent. But let's say everything goes through just great. Attorney review period is over. Home inspection was great. Then you're going to take that contract, that signed contract, and submit that over to your mortgage lender. And now we already have all the information in the system. If you did a pre-qualification, we already have you still set up in the system. If you did a pre-approval, we already have all your docs already in the system. Once you send us that contract, we're then going to plug in that property address. We're going to plug in the information as far as the sales price, the taxes, and all of that information. And we're going to submit to, I'm going to submit to a process, and the process is going to then order your appraisal. The appraisal is going to go, appraiser is going to go out and look at that property. You're going to start submitting, if you didn't already, submit all of your documentation over to my process. Documentation, pay stubs, W-2s, tax returns. We're actually looking at all the information that we need. You said you have $10,000 in the bank, 15,000 in the bank. We're looking at 2 months bank statements. Now, um, as far as the bank statements go, this is not the time that you want to go dump a large deposit in your account. When I say large deposit, anything over $1,000 is considered a large deposit. The reason is because an underwriter will, when they receive those bank statements from you, they're going through the bank statements with a fine-tooth comb, and they're looking for anything outside of the norm. So if you're putting large deposits into that account, you're going to have to trace and backtrack and be able to source where those large deposits came from. So a lot of times we know people that have money that they keep in the house. Sometimes they may get a large chunk of money from the relative. That's why we say get a gift, get the gift letter. That's easy to source. Then you just get a check from your relative and dump it into that account. So if you have questions like that on the assets, let me know. And we'll show you how to structure to get it into the account, but you don't want to go start dumping money into the account when we're asking for the statements, because an underwriter will ask you to trace where that money is coming from. So once you start submitting all of that, if you told us you had 2 years of that you've been on your job for 2 years, the underwriter is looking for those 2 years W-2s and that kind of thing. Now, just to let you know too, this is also the time that you want to make sure you stay on your job, because like they will do another credit report. They do an employment verification on you when we start this process, and they will do one for you when you get to the closing department to make sure you're still in your job. But you submitted all this documentation, we get the appraisal back, everything checked out. So we will then package that file up. The processor will send it over to underwriting with the appraisal in it, your income, your W-2s, your pay stubs, contract, everything, and then underwriters then will review that loan to make sure it fits exactly what the investor is looking for. And then the underwriter will then issue you what is called an approval. Now, that contract that you originally signed with your real estate agent, you're going to have some dates on there. The first date is going to be that the seller will be looking, the seller and your attorney and realtor will be looking for what is called the commitment, what day that they want you approved by. This is the date we need to show everybody that, hey, you have an approved loan. The next date that's going to be on that contract is your closing date. So when we get that contract from you, we have a ticking clock at that point. We need to make sure we meet those dates. We need to make sure we meet your commitment date, and we need to make sure we meet your closing date. So as soon as you get the contract in your hand, you don't want to delay that getting to us, because that's going to delay what we need to do. But now we have everything in place. The underwriter has approved the loan, and we've issued your commitment to you. Now, sometimes the commitment comes out with what's called conditions on there. Conditions a lot. One of the main conditions will be your homeowner's insurance. Remember, I told you you have to get homeowner's insurance, so you would go to New Jersey manufacturers, pay your insurance policy, and get the policy over to us. Submit that back with your approval, and then the approval will be underwritten again by the underwriter to clear to close. Well, that file is now, your loan is now what is called clear to close, and will go over to our closing department. What our closing department will actually do at that point is start talking to your attorney, and then going back and forth with any money that you've already put down. For example, that $1,000 that you used as a good faith deposit should be now in your attorney's hands. And your attorney will tell us, hey, we have the $1,000 in good faith. They'll send us a letter, an attorney's letter. Your attorney will then send us the bill for the title work. He'll send us the bill for him or her. They would send us that bill so we could pay them, so we can now set it all up at the closing, what has already been paid. Our closing department is now getting the funds ready to wire that $190,000 over to your attorney's escrow account, so that way your attorney can pay the seller. So what happens at this point, your attorney will call you and tell you to come in, and you would need to sign a lot of documentation. We will send to your attorney the closing package. The closing package has everything in there. Some stuff you've already signed before, some stuff you're signing again. Your attorney will walk you through everything that you're signing. We would have wired the $190,000. Your attorney is going to tell you to bring the other money that you need as far as closing costs plus the $9,000 deposit. Your attorney will tell you to bring that. So I think it'll say if it's $16,000, you've already given $1,000. Your attorney will say bring $15,000 to the closing table. You would do that. You would sit down, you would sign all of these forms. Your attorney is then going to give you the keys to the property, and your attorney is going to then cut a check over to your real estate agent, a check over to the selling agent, and a check over to the seller of the property. And at that point, you are a homeowner. And then you can actually call Raymore Flanagan at that point and get the furniture that you want to buy and all of the other things. But just remember, don't make any, when you're getting to the mortgage process, do not make any big transactions. No car, don't go buy a car, don't go buy furniture. Try not to make any big purchases until you're done with the whole transaction, because it can change what you qualify for. So that will actually bring me to the end of this. Now, like I said, we have resources at the credit union. We actually have credit counseling. Jamie, I don't know if Jamie's going to touch on it, but we can get you information on credit counselors. And we usually do that for first-time home buyers, because we walk you through getting you qualified, but home ownership counseling will also walk you through a budget and how to get ready to be that first-time home buyer. So they give you a written budget and help you get on track right away. And they also give you a certificate. Most times, if you put 3% down, that's the first time home buyers program, we need a certificate for that. But we are available at the credit union, like I said, at 8 o'clock till 6, sometimes later. And we also always have people there in the mortgage department that can answer any of your questions. So that brings me to the end of the presentation.
All right, thank you so much, James.
Oh, you're welcome.
So yes, if anybody has any questions right now, please feel free to submit them in the questions box in the dashboard, and we'd be happy to answer them. Just from personal experience, I'd like to make a comment, and this goes back to the home inspection. Um, when I bought my house, eventually we ran into an issue with mold, and I went back to look at the home inspection, and it was never brought up. Come to find out in the fine print, the inspection company did not do anything related to mold. So just again, with everything in the home buying process, read the fine print. If you have any questions, always ask, because this is something that could have been mediated at that point, but after we bought the house and did all of that, the attorney said there's not much we can do right now,
Mhm.
you know, with things. So just be
Yeah.
aware.
Yeah, yeah, I agree. I did this when we purchased my home. We had a bathroom over the foyer when you walk into the house, and when we did the home inspection, everything was fine. And all of a sudden, I was walking out to go to work one morning, and my wife was taking a shower, and water was dripping down. And it turns out that the seller of the house just actually repainted the roof and just covered it up. So when the home inspector comes, he's not cutting over the roof or anything. So it's something he couldn't even tell. And not until you start using that shower more and the water starts dripping down, you're like, oh my goodness. And we had to end up having the whole thing fixed. So that's why it's important to try to go through and do a home inspection and try to catch this stuff if you can.
All right. Is the Credit Union of New Jersey working towards getting VA loans? If so, is there a timeline for this?
No, we're working towards getting the FHA. I'm a big pusher and big believer in the VA loan, but I think right now I think the FHA is probably more on their radar screen for this year than the VA is. But I do desperately want them to get it, but we're not in the process of getting it anytime soon.
Do you recommend a mortgage broker?
Um, I, I I do, as long as they're going to be honest with you. So a mortgage broker, the way they work is a mortgage broker has the ability to talk to, let's say, 4 or 5 different banks at the same time, so to get you the best rate possible. They unlike with banks and with mortgage companies, their compensation comes strictly on points and stuff. So you may pay a little bit more by using a broker, but you do have access to a lot more product because they can use Bank of America, TD Bank, other different lenders to find the best product for you. And the reason I say, as long as if you trust them and if they upfront with you as far as all of the fees and stuff, then they are a good way to go. Yes.
All right. No more questions right now, but we can give it a couple more minutes in case anybody
Okay.
thinks of anything.
Yeah.
Thank you, very informative, somebody commented.
Oh, you're welcome. More than welcome.
How many different lenders should I work with?
I would range it down to about as far as sourcing around about three. You want to talk to about three. If you start doing too many, you're going to drag your credit score down. And so you would pick if you, I would probably say if you just want to really source it out, maybe two banks and one mortgage lender, or if you do one bank, one mortgage lender, one broker, just so you can kind of feel the difference in the fees and the different products and stuff. But I wouldn't go more than three.
Right. I was unemployed and just got a temporary job. My spouse has a full-time job for over 2 years. How would that affect my qualifications?
Well, the temporary is the thing that's going to get you because an underwriter is going to want to make sure that you are on that job for 2 years or longer. So if it's a temporary thing, I would probably wait until I know I have till either that they hire you at that job or you have a job where you know you're going to be permanent. If your wife makes enough income, we can qualify her, put you on the mortgage, but then qualify her mostly off the income. But if you're looking to try to qualify with the temporary, I would wait until I have a permanent job before I go with just the temporary.
A couple more comments. Very informative session. Thank you. And this has been a great webinar.
Well, thank you.
Do you have any recommendations for finding an attorney to assist with buying a home?
We do. We will give you a couple of to choose from, so that way you can actually make the decision. A lot of them all of them we have worked with before. They're all great attorneys to work with, but a lot of times, even when we are recommending a real estate agent to you, we like you to be able to source out and see who you will be comfortable with. So we normally would give you about three to choose from. Same thing with real estate agent, we'll give you about three to choose from. So someone that you'll feel comfortable with. Because I know a lot of times first-time homebuyers may have a lot of questions, and some attorneys are feels like sometimes they're quick to give you an answer, and some attorneys take the time and explain everything to you. So a lot of times we give you those options so you can call up and see who you're going to be comfortable with.
And I can say from personal experience, our realtor suggested an attorney that she worked closely with, and it turned out to
Mhm.
be a fantastic partnership. So
Right.
there are different ways that you can do that.
Right. And a lot of times it's usually best to go to because with the real estate agent, and I always tell a lot of first time home buyers, just don't feel like that it's a thing where you have to use it, but a lot of times they will recommend someone that they've worked well with that can make the transaction go as smooth as possible for you. And so that's why they were able to suggest people as well.
If I purchase with an FHA loan, can I later refinance and switch to a conventional loan?
Absolutely. So that's what a lot of people do because FHA, I didn't touch too much on it because we don't have the FHA product. So what FHA does, when I was telling you about the mortgage insurance that you have with conventional, FHA has an insurance that's on there, but it's on there for the life of the loan. So you have an upfront premium and then you have the monthly premium. And the premium never goes away. So conventional, once you reach 80% or 78% loan to value, the mortgage insurance eventually comes off of there. FHA, you can pay the house all the way down for 30 years and always have that mortgage insurance on there. So what a lot of people do is FHA is a great first-time home buyers product, but it's not one that you want to stay in. So you want to get into that house, get qualified. 3 or 4 or 5 years later, you want to turn around and maybe refinance into a conventional. And at that time, hopefully, as long as the value has increased in your property, you will be able to avoid the mortgage insurance with conventional as well because you'll have enough equity in there in order to eliminate the PMI and eliminate the mortgage insurance from the FHA as well.
All right, we can give it another minute or two and see if any more come in.
Okay.
All right, well, before we end, I just want to say that this program is being recorded, so everybody will receive a link to the recording as well as a write-up of the program. So in case you missed anything, you have that to reference to. If you would like to share it, please feel free to share it if people you know are looking for homes. Um, but I'd like to extend my deepest thanks to James for presenting today, and the Credit Union of New Jersey, who's been a fantastic partner with us for programming. And I'd like to thank all of our attendees for attending. You keep our programs rolling, and we do appreciate your time. And hopefully we'll be able to see you soon. But in the meantime, be safe, be well, and take care.
Absolutely. Thank you, Andrew. It's good to talk to you, man.